Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now, to the show at hand.
Hello, Yoni Schmidt here, hosting today's episode of the Same Day Podcast, where I connect with top business and real estate leaders. Past guests include Marissa Locasio from 1031 Exchange Corp, Jared Goldfarb, VP of Commercial Lending at Bank First, and even Noah Bleicher, Director of Operations at Capital Homes. Today's episode is brought to you by Keyrenter Property Management. At Keyrenter Property Management, we are a full-service property management company helping our clients buy, renovate, and operate real estate assets. We help our clients build wealth while taking the headache out of property management. That is why no matter what rental you have, a single-family home, condo, townhouse, apartment, we have the management solutions for you. Go to keyrenterpmc.com or email us at info@keyrenterpmc.com. Welcome to today's episode, where we are delighted to host Ryan Blackstone, the visionary team leader and problem solver behind Blackstone Company Real Estate, based in the thriving market of Northwest Arkansas, which we love. With a deep-seated passion for finance and an impressive track record in real estate investing since 2003, Ryan has established himself as a leading figure in the industry. His expertise spans guiding both his team and clients through the intricate world of real estate investments, ensuring every transaction is as smooth and possible. Armed with a bachelor's degree in finance and a minor in business management, Ryan's approach to real estate is both methodical and innovative. He's dedicated to helping others unlock their potential to build wealth and make significant impact in the world. Today, Ryan joins us to share his invaluable insights on analyzing investment opportunities in single-family and boutique real estate, where whether you are a seasoned investor or just starting, Ryan's expertise will illuminate the path to success in residential real estate properties, emphasizing the crucial aspects of principal reduction, which we'll talk about later, depreciation, some tax advantages, and other useful avenues. Join us as we delve into the world of real estate investments with Ryan Blackstone, a true wealth of knowledge and inspiration in the field. Ryan, welcome, and thank you for being here. How are you?
Man, Yanni, thank you. Thanks for all the kind words. I love it. It's Pie Day. We got to eat some pizza too, man.
It is Pie Day, yeah. I just realized that. Wow. Thanks for reminding me.
Yeah, you get some cheap pie here. You got to have some good gigs over there too, so.
Yeah, I'm in Tulsa. You're in Springdale, I'm guessing?
Yeah, Fayetteville, is where I live. But yeah, Springdale is our office. Yeah, so.
Yeah, beautiful. Well, Ryan, let's jump right in. Can you share a little bit about the genesis story of Blackstone Company Real Estate and what inspired you and your twin brother, Jared, also known as the Spare Parts, to start the venture in Northwest Arkansas?
Oh,
Jared doesn't like that joke when I say that, I guess, huh?
We'll see when he watches this. So. Oh man, no, yeah. So the genesis was really ultimately I lived in Europe for 3 years. Knew I wanted to do international business. Came back, started learning at the University of Arkansas. I was raised here since I was 2 and in Northwest Arkansas. And so through that, I wanted to start businesses. And I knew real estate investing was the fastest way to earn millions, to hopefully get a passive income goal to then go start other businesses in other countries. And so the genesis began doing investing and screwing it up, and then getting my license to learn the law to not only be above reproach, but just at least know the minimum standard, which is the law. And so that was the genesis. It's created to a point where now we've got 10 agents versus an employees. And we're doing a good amount of sales and good amount of investments. 6 out of the 8 agents on my team are investors, which for me defines as they own or have flipped a property that is outside of their personal residence. And so I love it. And I love seeing the life changes in the agents and in the clients that we have. So,
yeah. That's really, really interesting that you're very, let's call it intentional with the agents that you bring into the office and the agents that you want working at Blackstone and Company Real Estate in the Northwest Arkansas and wherever you expand into, right? That they have this experience, because you know better than all that it takes a lot of time to learn these things. You're sometimes running very fast. There are a lot of moving parts, and sometimes people have that baptism by fire scenario, which it sounds like you may have had that at the beginning. And, we'd love to learn a little bit about, what happened there and how other people can learn from, your experience and what you've gone through. With a background in finance and business management, I know that you look at deals all day long. I look at deals all day long. We're both using different types of tools. We're using, you have your own mega spreadsheet that you've put together, I guess, that I'm very impressed with, and I love seeing your reports, and you've even shared one with me. And I use another tool like Riskcover to analyze these opportunities. Tell us a little bit about your background in finance. How do you approach underwriting an opportunity, helping an investor understand if this is something that is a suitable investment?
Well, Yoni, I think that's why you and I get along, because we speak numbers.
Yes,
you guys do great. And so when I talk about ROI, ROE, whatever, you guys know what's going on. And we were like, oh yeah, that's a better way to think about it. So yeah, my degree, finance management, and then so I love the finance. I love the numbers. I actually started out in accounting, but moved into finance because like accounting was like looking at the past and how did we do? And I'm just like, hey, where are we going? Is my natural sense. And that's really what finance is. And so taking it into real estate, especially with investors, what I do love, I'm going to say this, investors are typically logical, or the true investors are logical, and they'll be precise in where the numbers are. And we can get creative and figure out different ways to make the numbers work. I say that to say there's still emotions because it's still humans, but I think what I love is the numbers don't lie, and the numbers just speak the truth through that. And so I'm not as sophisticated as you guys at Keyrenter. You guys got the whole website that really would help out any agent, any investor to really analyze a deal. We still use a Google spreadsheet, but I love building them out. It's like my hobby. People are like, "Oh, do you go out golf?" I'm like, "No, but I'm a freak of the sheets. Let me tell you."
I love that.
Yeah. So Jared got me a cup that had but so yeah, we kind of built out some spreadsheets for deal analysis of any kind. It was mainly out of two realms. One is to teach and educate, as well as share. Like you and I, we are underwriting. Oftentimes, some newer investors or younger investors don't even know how to underwrite. So my team, one of our primary goals is to help give that trust and that support and that confidence that they need in that deal analysis and underwriting to say, yeah, this is a good deal. You should go forward. Here's all the reasons why. And it's all spelled out into the numbers. So it helps to like take the emotions out, even for myself, to be like, hey, I'm running this deal. And then like, I get this thought of, oh, what if the world crashes and now I'm losing money on this deal, right? And it's like, oh, wait, the probability of that is so low. Let's actually really analyze this and look at this. And then we can take out those emotions and say, is it a deal? Because does it meet our metrics? Yes or no? So yeah, I love it.
And so when you're analyzing deals, one of the first things to do with a client who's looking at investing in real estate is to just understand their goals, right? Because every client has a unique set of goals. One has the goal of I'm looking to supplement my income, so I'm looking for the cash flow. One is saying, I don't need the income because I have a high paying W-2 job or some W-2 pay job that, I can support myself, and the real estate just needs to sustain itself. Maybe if I'm a high earner, I can fund it a little bit every month, but this is for the long term. And each of those may result in, underwriting different opportunities. Help us understand, I guess, once you've set your goal, right? We're looking at a deal, and today it's difficult to make things cash flow, right? We're Pi Day on 2024. Interest rates are, if you get preferential, rates today, you're probably at 7%, 7 to 8%, call it. Anything else is probably 8 to 9%. Is that what you're seeing in the market?
Yeah. For a long term, short term, you're getting 12 to 18% on the loans. Yeah.
So in those instances, right, where someone's saying, okay, this is a long-term play for me, and I'm really interested in finding a good opportunity that's going to continue to appreciate at a good rate, right? What are common things or metrics, financial indicators that people ignore? What are common things that people should, point their finger to and say, this is a good indicator for me to, buy, walk away from this deal, try to renegotiate the price, whatever that may look like, right?
Yeah, that's great. So what I have loved in Northwest Arkansas for the longest time is things would cash flow, and you could buy a 1% deal. But then there came a time where it was like, no, these aren't cash flowing, or they're not hitting the 1% roll or whatnot. And so some people were saying like, okay, well, I'm just going to throw it in the S&P 500 or something like that. And I was like, wait a minute, you're actually still losing. You're not making as great of a return as you could in real estate if you do buy this property, even though it may not cash flow. And so throughout any deal, right, there is kind of like 4 metrics in which real estate works out and like actually brings you more money and overall brings you more net worth. Obviously, what we just talked about, which was cash flow, like how much money in excess am I getting from income coming in and expenses going out, right? But then there is your debt pay down or principal pay down or principal reduction, whatever you want to call it. It's just the amount that is going towards that principal payment. Because most people are doing loans, right? They may buy it all in cash, and that's their prerogative. But most people are doing that principal pay down. Then there is your appreciation over time. So how much is that asset actually going up in value? And then which is a hedge against inflation, right? We've seen that specifically through COVID, right? And then the last is just your tax benefits, right? Tax deductions. So where almost any expense in real estate can be reduced in taxes. Your interest rate can be, you're actually decreasing your tax load by the overall value in which you purchased the property, right? And so whereas that's contrary to like just throwing money into a money market, stock market account, right? Where oftentimes you could be double taxed on stuff. And so you got to take those factors into account. And so what we started doing was, we still look at, individually, what's our cash flow, but then we're starting to look at, hey, what's your overall return? So that then you can look at, with all 4 factors, compare it to the stock market and say, which is the better investment, right? And still, you can be very conservative in how much you think it's going to appreciate. You can even reduce your tax load, like saying, "Hey, I'm at aggregated 27% tax bracket, but maybe that won't be forever. So let's drop it down and still think, okay, is it a better return in other places?" And so that's kind of like what we have seen and what we transitioned to, now there is a step forward from that, because we're looking at just what we were talking about is, hey, you know, your investor defines what their buy box is, which is like, hey, if any investment fits this parameters, I'm good to buy, right?
Mm-hmm.
And then we take it into looking at just one individual deal and say, does it meet that buy box, and how does it relate to other opportunities I might have, right?
Mm-hmm.
But you could take it a step forward, and instead of just saying, what is my return on investment, you could say, overall, in the years to come, what is my return on equity? And so, like, for us, we really, like, I'm it's like coming to my head, right? But we really I like to help people secure their life within their, like, maybe even it's just their single family house, right? They're generational renters, and then now we're moving them into like buying their own home, and that's still a net positive benefit over the life of them, right? Or it could be just taking someone's portfolio and making it greater, or even taking someone who's like right now, there's a teacher, and I'm like, hey, your equity position is 60% into this house. What if we can make you an extra $500 a month, but also secure that, know that if you buy this property, it will be paid off in 30 years, and your retirement just has shifted to being possible, right? And so that is return on equity. And that's what we're also looking into more and more as we analyze deals for our investors, and saying, hey, let's zoom out to not only just this one investment, but zoom out on your overall portfolio, your overall net worth, right? So that's what we're seeing.
Yeah, I mean, and that equity piece is so important, right? It's it's really what establishes and defines your net worth, right? We talked about this on the front end before we started recording, but your net worth is really your assets minus your liabilities. So when we're looking at opportunities, right, many investors, oftentimes, they look at the cash on cash return and they say, this is suitable, this isn't suitable. A lot of investors are also familiar with the cap rate, right? Capitalization rate, which is a commonly used metric in real estate to, determine whether or not it's a good, suitable investment opportunity. But many people forget that your cap rate only matters for your first year, whereas your cash on cash return is really something that is throughout the life of the loan and or the investment, and your return on equity is also throughout the life of the loan, right? Because you would really drop to like 0% if you're buying this out cash, right, on your return on equity, right? You have full equity in this property, and so there is no return on the equity, but it's the appreciation and it's the cash flow.
Yeah.
For those investors who, are looking to invest, right, oftentimes they forget about the principal reduction, right? And I've seen this happen twice with your analysis and with the Tyler Bennett group out of Utah, who, they are involved with the Chris Crone Consortium fund that, buys a lot of real estate, and it's a big name in the world of real estate. And we're grateful to be managing many of those properties in the Tulsa, Oklahoma City, and Northwest Arkansas markets. But you and them both take that principal reduction and you bring it back into the investment to, show a true return for your internal rate of return, right? To understand, and what does this truly look like? Can you talk to us a little bit about that? Why is it so important to never forget about the principal reduction, and consider it when you're thinking about your goals in real estate, whether it's, I need the cash flow, or this is a long-term play, and 30 years from now, I'm going to enjoy the fruits of of my labor that brought me to purchasing this property.
Right. Love it. Thank you. Yeah. So I look at it as first off, two vehicles you must have to really be successful. You need a vehicle that makes you a high amount of capital. So that could be a high paying job. That could be flipping properties. It could be wholesaling properties, wholesaling properties, whatever it is, right? You need a high capital earner thing. And then once you make that capital in excess of what your burn rate or expenses are, where can I throw that in to make that passive income? And the one thing that honestly really hurts on real estate relative to the stock market is our liquidity and our ability to compound, right? So in real estate, you'll get those cash flows, and cash flows are great. And really, cash on cash return is only counting for that first year. And that cash flow, actually, it's two different words. Cash flow is literally the amount of money coming in, right? Which will always go up, right? Your cash on cash return should and will always kind of go up as well. But your return on equity actually goes down over the life of owning the property, because now you have more capital stored up in one deal. And even though your cash flows are going up, your equity is actually going up at a more significant amount, right? And so that disparity actually means your return on equity goes down. And so how do we though then take that, which is you could even be in a market with no appreciation, right? And still your equity is growing based off of your principal paid out, right?
Right.
And so it is very important to then figure out how to access that equity to then go make more money, right? So in the stock market, it's super easy. You just click a button that says reinvest and buy more stocks so it can make more money, right? Make your cash make more cash. And so when you only look at cash on cash return, and you're not counting in over the life period, because real estate should never be looked at in a 1 year perspective, right? In all honesty,
you'll probably lose if you look at it that way.
Yeah, you're losing every day, right?
Every day, yeah.
But you see that all the successful people they own real estate, but oftentimes they're always working the deal. And my personal love is you go and refinance. So when you refinance, though, your cash on cash is going to go down, right? In that particular deal. But what if you take the equity, or you refinance, or you take a line of credit out of that property? So now you have access, liquidity with that equity, and then you go buy another property, or heck, throw it in the stock market if you're like, you want to diversify. If you're bullish, right?
Yeah. What? Yeah. If you're bullish, I mean, you throw it in the stock market. It's tax-free money, right? You've already paid the taxes on the income on that money. I guess it's not really income, but you paid the money on that, the taxes on that equity, right? And it's tax-free when you pull it out. I guess the other option is if you're dead certain on wanting to redeploy into real estate. I mean, you could leverage the 1031 exchange IRS code and just redeploy into a like-kind asset, right? So, and so people often forget about the principal reduction. It's, you mentioned this earlier. It's a forced form of savings. I like that term. It's something that, we definitely need to take into consideration when we're investing in real estate, because ultimately, the idea is to access that capital through vehicles like, refinance loan products, or, 1031 exchanges. I guess tell us a little bit about what would you advise, I guess, a new investor who's coming into the market and evaluating, their first real estate investment deal? What are common mistakes that you see, and how can we help them avoid that?
Yeah,
or those?
great question. To be honest, the biggest mistake is fear of failure and never getting into it or taking action, right? You're never going to know the full steps. You're never going to know the analyzing it perfectly. You're not going to be the expert and the perfect. Now, that's where you lean on your team. You lean on your property manager. Hey, can I rent it for this? You lean on your real estate agent. How much will this be worth after I renovate, right? How much is it worth now, right? You lean on your contractor. How much does it cost to do this work, right? And so you do have to gain that trust. So if I were to say anything, it's like, man, get the right team in your corner, trust them, and pull the trigger. And you know what? It's also okay if you failed and bought the wrong deal. What's not okay is never investing, right?
That analysis paralysis just like cripples people, and they're unable to pull the trigger.
Yeah, I heard a good quote or something. I can't remember quite, so I'm gonna botch it up, but basically it was saying that the truths that you actually believe are at the level of your success, right? So the better you understand the truths that you're believing of yourself or of your environment, will dictate how successful you are, right? And so if you think like, hey, I got to get it right, I need to know it perfectly, I can't trust anyone, I'm going to get screwed. Well, that's what's going to happen, right? And so and if we're just looking at this one finite thing, right? It's like, okay, like if I were to be honest, right? When I started investing, people would say I was a failure. And it was like, I joined a course, I barely broke even, right? Had a couple people steal deals from me. It was not good. But I learned a ton, and that was invaluable. And I learned truths about myself of like I can stand up. I had a good contract. How could they can't steal from me, all this kind of stuff. And so if I were a new investor, going back to your question, because I love bunny trails, but if I were a new investor, one of the common sayings right now is like, if you're going to fail, just fail fast, keep moving forward, learn from it. And it's not about this one deal. It's about the lifetime, securing your life and legacy overall, right? Because that's the only way. There's never an easy button, right?
Right.
Unless you're really into Bitcoin. I mean, no, I'm just kidding.
Unless you bought Bitcoin in the year 2000, right?
Exactly.
And, there is a fast and easy button you can just cash out at. I saw it was at 75,000 last night. One Bitcoin was like 75 grand. Yeah. It's very.
Yeah, we were waiting for it to push past 60,000, I think. So yeah. Now
it's interesting to see, the Bitcoin rally, and then, it'll be interesting to see, how this continues or it doesn't. But with respect to real estate, I think the good thing is that it tends to be very forgiving over the long term. So even if you failed when you bought your first transaction, right, hold on to it, weather the storm, and and make your payments, and you'll come out on the other end a lot better, even if it requires some sacrifices in your life. So you don't take that one vacation, and you make your rental payments, right? Which should always be the course of action and the decision that you take if the two are in the balance of which one should I go for. But over the long term, real estate is very forgiving. And we know that things are cheap in the rearview mirror, right? When we look backwards, right? That contract that you had, which was a good contract, right? You're kicking yourself sideways and you're saying, I should have bought that. And I had an eightplex in Tulsa that I had the same experience with. And, I'm glad I'm not 60 or 70 kicking myself sideways, because I hear that's how you break a hip. But that eightplex, I should have bought it. And I didn't pull the trigger in 2016 to buy an eightplex for $150,000 in today's world, where this eightplex probably is worth, $600,000-$700,000. It was something that, you can only learn from. That's it. And just know that next time you won't skip out on the opportunity to go after something.
Yeah, but I love that you say that. You say, and that's really important, real estate is forgiving, right? So yes, cash flow and cash on cash is important. We want to make sure we can make those payments, right?
Mm-hmm.
But every person I hear, their regret wasn't the property they purchased, but the one they didn't, And
right.
That's just because over time, it always does well. So
right.
As long as you can
tell me, it's forgiving. You see it in the pro forma too, right? You can really see it when you're tracking your debt service coverage ratio and your return profiles and all the financial indicators. You see it in the pro forma. Let me ask you something about a little creative financing solutions for those who, for them, cash flow is a little bit more important nowadays. And they're saying, I want to continue to invest, and nothing really makes sense, right? What are your thoughts? And I've been toying around with this, and I have maybe 5 conversations lined up for starting tomorrow into next week with lenders who are friends of mine and, mentors and people that I trust and respect in the industry. But what are your thoughts, and what's your sentiment on putting an acquisition of an investment property on a 12-month period of interest-only payments on a 20-year amortization schedule, and inflating your cash-on-cash return for the first year? In certain instances, you may need to come in, 25, 30%, 35%, depending on the purchase price and what you can negotiate with the seller. But, you're inflated on the first year, and then you have to be in it with enough equity. So where, year 2 comes around, your debt service coverage ratio doesn't drop below 1.2, right? Because the lender won't, go for that. But, it's a little bit riskier. You're not paying off the property for the first year, and you still own it though, right? And that's what is challenging right now, is the acquisition piece of it. Is that, in your mind, a solution?
To a solution to it not cash flowing?
To investors who want to continue to buy and find it difficult because of the fact that properties are not cash flowing.
That's great, because over time they will start cash flowing, because now we're looking a longer period of time. Yeah, I mean, I like that. It all depends on someone's risk level, but the big thing about that is, I would, in my personal opinion, I'm funny enough, I'm not really risk tolerant, right?
Yeah.
So when you're telling me that, I'm like, oh, that is very creative. If like I want to build my safety net. In fact, we have an investor who bought a deal, and they're renovating it on they bought it with a construction loan, and they're renovating it. And that renovation and construction loan is interest only payments for a year, right? Mm-hmm. And so instead of refinancing right away, mm-hmm. he's going to hold that period for a whole year. It took him only 2 months to do the construction, get a renter in there. And him and I were just talking about, hey, just let that be your safety net. If you want, build up that reserve. That way you can hold it. Actually, in year 2, even if you were negative, you could then start chipping away at that savings, to see that it will cash flow later. That is a risky move. But I mean, for me, it would be a risky move to do that. And then like, I know I'm breaking even. I renovated everything. I know I'm breaking even cash flow wise, and I have a reserve if something else were to go wrong and I don't know about it, right? And so, and it seems not to say it can't ever happen, right? But typically, when you're in a deal like that, you're going to have some kind of equity because either you value added it or you brought a down payment or whatever. But to see the market drop below an amount where you're going to actually eat the worst case scenario is you have to sell, right? And to see that you would sell and lose money, especially for holding a property for a year or 2 years, it is kind of hard for me to see that, especially when you do it in a shrewd, wise manner. So,
yeah. So, that's interesting that you say that, because my conventional, thought has always been like, you can never buy a property and hold on to it for 2 years and then sell it, or 1 year and then sell it. And I guess it really just depends on your purchase price. From my perspective, it was always, well, whatever I'm buying, that's it. I'm going to keep, right? Because of a bunch of different reasons. The depreciation aspect of the sale that you have to recapture on your taxes, the capital gains, whatever it is, right? My thought has been, I buy something, I keep it. That's also, what I was planning for my own retirement in the future. And it really depends on how you buy it, right? If you buy something so under market value and you hold it on for 2 years and you're renovating it and you're forcing appreciation and adding value into it, sure, you could make a good margin on it. Interesting stuff. Tell us, what else are you seeing, I guess, in the market in Northwest Arkansas? Activity levels, inventory levels. Where are we with your market?
Yeah, it's going good. Last year we appreciated by 9%.
Wow.
So where other in the country where others are either 0 or maybe a little low, maybe even just a little bit high. 9% is, we still run conservatively and say our appreciation levels are 3% just to like keep up with inflation. Even though inflation's been everywhere, so 9% is amazing, right? And then we have seen the volume drop by a third based off of how much has been sold during the years of COVID. And honestly, I would say it's like the era of cheap debt, right?
Yeah.
And so
the good old days.
Yeah, the good old days.
The good old days.
2 years ago.
But maybe in 2 more years. Who knows?
Yeah. Honestly, you're right. You're 100% right. Someone's like, oh, it's expensive. It could be cheap 2 years from now, when
you look at the data about inflation that just came out, right? We're seeing that it's actually higher than what was anticipated. And so, the Fed is going to have to start pulling some levers and making something move. So maybe towards the end of this year in 2024, no one has the crystal ball, but maybe towards the end of this year, we'll see some rate cuts, and that will do a few things, right? The ripple effect from a rate cut will, have effects on the market, like price increases, right? I guess the price increases combined with the rate cut could potentially mean that people have more access to, buying homes, but not necessarily. And it really just depends, right? And also, how much equity are they putting down, right?
Yeah.
People far too often buy 5%, right? With 5% down payment. Don't expect those properties in a year or 2 to cash flow when you say, I'm going to become a real estate investor and, rent this out.
Yeah. What we're seeing a lot with our investors, and specifically for off-market deals, is we are seeing really good creative stuff coming in where, like for example, technically there is a way, like a contract for deed, to do a sub-2 for any kind of deal. The ways I love, because again, I say I'm more risk adverse, is I love FHA and VA. In fact, my wife and I are looking to buy a new personal house for ourselves. And the way we target for our direct mailers for letters, and then we're going to cold call, is specifically FHA or VA loans that when we knew the rates were just ridiculously low. Like we looked at one that was 2.25%. Year one, first monthly payment, you're paying more to principal pay down than you are the actual interest.
Wow. So you're targeting them for subject to.
Yes, specifically for subject to. And we're seeing that happen a lot more. We're seeing owner finance happen a lot more, where a lot of older people are ready to retire, and they don't want to get hit with that huge tax bill, and they would rather see a monthly amount come in. And so they're willing to sell and owner finance a deal. And you may not win on overall sell price, but you're winning on that debt, right? And not having to come out of pocket for that. And then we are also seeing a difference in the mindset shift for overall sellers. What we're seeing is, now, mind you, I feel like it's just going back to 2019 for the most part, except for what we just talked about, which was the creative finance, because debt was still so cheap back in 2019. But I am seeing a lot more death, divorce, depression, all these negative situations that are causing people to want more conveniency than overall price, right? And so, it's actually been kind of crazy. There's two factors we keep finding. One is grandparents who bought properties to allow their grandkids or their kids to live in to help them out. They destroyed it, and then it's like, okay, now we're coming in and they're like, I just want to get rid of it. Their emotions are so tied up in, like, I tried to help support family. And then the second thing is solar panels. We just see so many people get these solar panels, and now they're like $40,000 on top of their actual mortgage debt. And they're struggling right now, and so we're like, man, this is crazy. Like,
owners of homes that have solar panels, they essentially finance the solar panels, and now they're in a place where it may not be worth it because they're not contributing to the grid, or the cost offsetting the cost benefit was not where they needed it to be.
Right. Because what happens, one is, you got your solar panels, it's $40,000 debt, right? And then really you should upgrade to a battery pack, because most people work like a 9 to 5, right? And so they're charging back to the grid, or giving back to the grid, and they're getting maybe like 16 cents per kilowatt or whatever. I don't know. Don't quote me on this.
Right.
But then their demand when they need to use it is 56 cents per kilowatt, right? And so it doesn't equate unless you have that extra thousands of dollars for that battery pack, so that you're using your active solar energy before you use grid energy, right? And so then the second piece is it's not a 1-for-1. You buy $40,000 of solar doesn't mean your property just appreciated by $40,000. So they're listing them and they're not selling them just because you can't just tack on another $40K, So,
right. It's not a bathroom or a kitchen.
Yeah. Yeah, exactly.
So,
Exactly.
Yeah. It's a pool.
Yeah. Yeah. It's just interesting to see, like, when you're looking for off market deals, you start seeing these patterns come in. And it's like, okay, how do we creatively help them solve the problem here? And that's what we're seeing a lot. So
love it. Okay, Ryan, thank you. I guess, you know, I want to be conscious of our time here. So, you know, I know we want to end here, you know, without going too much over, but this was really inspiring and very eye-opening, educational, and I love seeing what you guys are doing in Northwest Arkansas. I was just at your office last week, was it? Yeah. Yeah, on Friday. Can't wait to see it done.
yeah.
So, you know, I'll have
You
to
and me
pop
both.
in. Yeah, I'll pop in on you guys soon. But thanks again so much. Really appreciate it. And if anyone needs to reach out to Ryan, how would they do that? They would email you.
Best way is go to our website, blackstonecompany.com. You can go to the about, and all our contact cards are going to be there. You can also reach us in any social media platform pretty much. So, but hey, Yoni, thank you so much for letting me be a part of this. And I always appreciate the value you guys bring in to all investors, and hopefully new investors to come in as well. So
many new investors, hopefully. Yeah. Thank you so much. See ya.
Appreciate you.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.